Welcome to Chit Chat Money. This is our Thursday deep dive episode where we interview an analyst to discuss a single stock or industry. And today we're talking with Andrew Marshall. He is an analyst at Capital Mindset. And the company we're talking about is Paylocity, but he has kind of a unique perspective on it because he's been a customer. He's explored alternatives. He understands the human capital management software industry really well in terms of all the alternatives, and just has kind of a unique perspective on the business in general. So lots to like here. The business has also grown revenues basically 10x over the last 8 years. So it's been a high growth business. I know we haven't done as much software businesses lately, but hopefully this one is exciting for you guys. I don't think we have any other things I should mention here in the intro. So without further ado, here's our interview with Andrew Marshall.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schafer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are also general partners at Arch Capital, and Arch Capital may have positions in the securities discussed in this podcast. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guests is not formal advice or recommendation. Now please enjoy this episode.
All right, welcome in. Today we are joined by first-time guest, Andrew Marshall. He is an analyst at Capital Mindset and someone Brett connected with via Twitter. We're talking about a company maybe some people have heard of. It's Paylocity, software business. I guess, Andrew, you kind of have an interesting story in terms of, well, I don't know if this is exactly how you found the stock, but how did you come across the business to begin with?
Yeah, so I work for a company as a finance officer, and we were very unhappy with the HCM, which is human capital management, is what they call themselves. So I think payroll, HR management, stuff like that, company. They just had a lot of issues with processing taxes, getting things done in a timely manner. So we started to look at taking bids, and that's kind of how I ran into Paylocity. They're an HCM company. Think of like ADP, somewhat kind of similar to Workday, although they don't exactly play in the same field, or Paycom. So that's the field they play in. That's kind of how we got introduced.
Yeah, let's go through, I guess, the business basics to start. Human capital management software, kind of a broad category. What exactly does Paylocity do, and what intrigued you about the business?
Yeah, so think about anything that your HR department does. That's what they're going to deal with. So think about onboarding, think about client files, think about benefits administration. So if you have a 401k, you have medical insurance, things like that, they'll do that. Obviously payroll processing. So they're the ones that will process payroll for you. Even offboarding, performance reviews. And now they're kind of they have a part where they just kind of, I guess, informational stuff like pushing out notices to employees, anything like that, general announcements. So they kind of do anything that your HR department will do. They're not a, things called a PEO, like they don't replace your HR department, but they'd be the software your HR department uses for everything within their sphere. As far as what intrigues me about the business, just looking at it when they're going through these pitches, I said, one, this is super asset light, and margins are going to be really good. I mean, it's pretty simple. You set up the software. There's some management on the side of Paylocity they have to do, but for the most part, you're going to have high gross margins, and it should mostly flow to the bottom line.
Yeah, let's dive deeper on the unit economics here. What are some of the numbers behind the margins, as you mentioned? And as a software business, what are the major costs here? Are we looking at just employee stuff? And then today, like what margins are they earning from maybe a gross and a bottom line basis?
Yeah, sure. So really their main costs, to your point, it's just, employees. So, they have roughly, I think right now it's 70 to 75% gross margins. And most of that within their cost of sales is just paying the employees to process payroll, paying for the cloud, what's the word? The cloud infrastructure that they use. And then, if you look at their expenses, it's primarily SG&A. There's some R&D that they do as well. Developing new modules, new things for their customers. But really it all, about 75% gross margins. And right now they're about 20% free cash flow margins, or maybe it's 18%, but they even just announced, those are continuing to go up and their long-term target's closer to 25% free cash flow margin. So, in my opinion, really solid on that front. And they can do that at scale. As they get more scale, it'll become better margin-wise.
Right. And maybe you don't have this in front of me, but how I know a lot of people, a lot of listeners to our show are going to hear, because we harp on it all the time, free cash flow margins for a software company. What's the SBC? What's the stock-based compensation? How efficient or inefficient are they with that? Do you have those numbers in front of you? Is that a highlight or a low light for you for this one?
So I don't have the numbers in front of me, but I believe last year it was about 145 million in SBC. That's off of about 1.1 billion in revenues. So it's a pretty high amount as a percentage of revenues. I would say it's closer to a low light than a highlight for me. I think the one question, and we'll get into a little bit deeper maybe about this business, the one question or low light in particular how this business is run, in my opinion, would be SBC, or just the SBC and also the, how would I say this, what's happening. So I'll give a quick sidebar. The founder, because the current CEO, he's been there since 2007. He's still going to be there for a long time. But the founder, who founded the company back in, I think it was 98, 97, when they IPO'd, he had 49% of the shares. Now he's down to 18, and he's kind of a he sells no matter what. What's the indiscriminate seller? And so you will have some selling pressure on you no matter what. That's one thing that I noticed is kind of a negative for me. It's not enough to turn me away from the business, but I think the SBC and that indiscriminate seller from the founder is something to be aware of for sure.
Right. And the context you're giving, it seems like Paylocity is still fairly, it's a sizable business, over $1 billion in revenue, but it's still fairly in its early days. It's still investing a lot for growth. And we know what revenue are doing right now, again, just over $1 billion. But what is the size of the market that Paylocity operates in? As I saw, or maybe I saw you mention, they operate in kind of the smaller, like small to medium-sized businesses. But again, Correct me if I'm wrong there.
Nope, you're totally right. So, I mean, Paylocity can supply larger companies. There are larger companies that use them, but they're primarily going to operate in that small to medium business. You're looking at probably somewhere between, under 1,000 employees is probably their sweet spot. And it is a very large market. And in my opinion, the trends, so from COVID, one of the things I noticed is that tax and payroll tax, especially, and having these things done correctly is very important. So one of the things that Paylocity really helped with was, I'm not sure if you're aware what the employee retention tax credit was, but it was basically more or less a grant done by the government that was run through payroll taxes. So basically said, if you had employees that you paid through COVID, we're going to give you up to $5,000 per employee per quarter through 2020 and 2021. Paylocity, for us, we had some issues getting some of the documents, some of the things we needed, like 941s from our HCM. I talked to Paylocity about this. They literally told us every single one of our customers, they had all the documents they needed same day. Like they had everything ready, they send it out. And I think as the tax code becomes more complex, I don't think it's going to become more simple. You're having a lot of these companies that run payroll themselves that are small to medium, or they're using maybe more smaller regional players that aren't as complex, and they're going to move towards a Paylocity. You know, they have a few people they compete with. Like ADP is one that comes off. ADP plays in all segments. And even, you know, ADP, I think they've called out that they're only have a penetration of like, I think it was something like 5 to 7% in the market. So it's very segmented, which is, you could argue, a good and a bad. but I don't know if that answered your question or if that.
No, yeah, I think that covered it. And maybe can you talk about some of the other competitors? You mentioned ADP. Who else does Paylocity compete with? We were talking about this before we hit record, but why did you choose Paylocity over some of these other providers?
Sure. So the primary competitors for them are going to be ADP, because ADP competes in all parts of the market. And then you have Paychex, which is another pretty large player, but they also focus more on SMB. And then you have Paycom, which I know a lot of people are familiar with, I think, or it's one of the more common ones if you're investing in HCM, as well as Paycor. So, and I'll just say this, Paycor is the one we're moving off of. And so that was one we're moving off of. And then Paycom was one, along with ADP, that we are taking bids from. Really, and I didn't go into this beforehand, but one of the things that I think makes Paylocity successful is they focus on customer satisfaction more than the other players. Like, everyone says they focus on customer satisfaction, but actually, I mean, Paylocity gets 25 to 30% of their new customers from client referral. Like, they have a whole client referral program. That's how they get a large chunk of their new customers. And even like another quick aside we'll get is, when I was going through this process, I actually got like a personalized video sent from the CEO, just being like that's, to me, showed they're very committed to, like, at all levels, trying to get people in, keep them happy, and listen to them, is what I heard constantly. Paycom is a company that's also great, but one of the things was they just priced us out. I think they were about 4.5 times as expensive as Paylocity. And
was there any, sorry to cut you off, was there any functionality that warranted the higher price? Is there anything that like Paylocity lacked? Yeah,
Betty is a really cool product. So I don't know if you guys talked about Betty. I think it was kind of nascent.
I don't think it was launched yet, or maybe it was like just having been launched.
Super cool product, especially if you have a lot of people that are working on shifts. So those every employee on their phone, they're just going to pull it up and approve their payroll. So it really expedites the process for the HR administrators. The other thing is, within my company, and I still don't know if this is worth it. Maybe for some organizations it is. Paycom, from what they were telling me, was so we have a lot of EINs within our organization. We have about 55 EINs sub organization. Like, so the structure is very complex. Paycom said that, and in reviewing, I don't think it'll be an issue for us, but they're transitioning between like intercompany transitioning. So if someone's moving from one company to another, they do that very smoothly. With Paylocity, it's a little less smooth, but for us, that wasn't an issue. So depending on the company, I can see the reason for Paycom, but I actually think that this move to Betty is actually pushing them more up to larger businesses. I think they're going up market with this product, and it's actually going to leave, I don't want to say a vacuum, but more opportunity for Paylocity in the SMB space.
Interesting. So you're saying that Paycom is actually less and less of a direct competitor with Paylocity, even though they're both generally benefiting from the cloud HCM tailwind.
Today's episode is presented by the Science of Hitting Investment Research Service. The Science of Hitting was founded by Alex Morris, who spent a decade working as a buy-side equities analyst before launching his own service in early 2021. You've heard him here on the show a number of times, but Alex produces really, really high-quality equity research. And in addition, he provides 100% transparency into all his portfolio decision-making. We were early subscribers to the Science of Hitting Research Service, and we genuinely believe that Alex produces research that is on par with top Wall Street analysts at a fraction of the cost. I mean, the fact that you also get complete portfolio transparency and 100% accountability is just icing on the cake. Effectively, you're outsourcing a full-time equities analyst role for just $349 per year. Brett and I both pay for the service on our own, and we can tell you that it's honestly worth the money. Some of the companies that Alex covers includes Microsoft, Netflix, and Meta, Roku, Costco, Match Group, Berkshire, tons of others. So if you're interested, check out the TSOH investment research service today at thescienceofhitting.com. Now,
For anyone that doesn't know, I guess you can look this up, but Paylocity, and again, these are all confusing because they all start with pay. But they've 10x their revenue over the last decade, give or take. Mm-hmm. Is there any reason they've done this besides just the tailwind of the overall market? Is there anything that makes them special? Is it because they're cloud-based? Is it because of anything that you think makes them stand out from the competition?
You know, I looked into this and I can give an opinion on why I think they stand out now, but that's not answering the question, which is why what's structural, what's been put in place by the CEO that's worked. You know, I even listened to the CEO kind of talk about this, and basically what he said was the two things that really made him, because someone asked him this question directly like 2-3 years ago, and he said, we listen to customers and we're agile. Like, we have no problem pivoting and making a change if it helps our customers. And really, if you think about this industry, okay, processing payroll, bringing on people, processing taxes, all this stuff, anyone can in theory do it. It's not like something it's not an AWS or something like that. The question becomes, how reactive are you to your customers? And that's kind of what the CEO hit on. And it sounds very simple, but I think it's harder to do than people actually think. And then to your point, being cloud-based fairly early on, I think has helped for sure. And I think it could just be as simple as having, early on a better sales team. I mean, I can tell you what they do better now than, because we took, 6-7 bids, and there are some smaller players that just don't have the functionality they do now, that I think it's going to really help them hit this space, moving forward. But I think that's been really what's helped them in the past was the current CEO, Stephen Beauchamp, listening to people pivoting and really, like I said, it shows. If you're having 25-30% coming from customers, I think that really speaks to how well of a product you're putting out there.
Okay, so you talked about the CEO briefly. Mm-hmm. What are your thoughts on him a little more broadly as a capital allocator? Is he someone you trust? I guess what gives you the sense that he's kind of worth investing in? And is he important to the thesis here?
Yeah, yes and no. So I think he's a really good CEO. I generally don't like trying to invest on a company based solely on a CEO. I think that's if you do that, then anything can happen. He gets hit by a bus, it's the proverbial. Then historically, he's been a great capital allocator. So one of the things that you're doing in the payroll space is trying to say, what's the next thing that our clients are going to need, and how do we invest in either research and development or M&A to get that, right? So personally, looking at the last few moves that they've made, I've very, very much liked. One of their recent acquisitions, and recent being like last 1 or 2 years, I thought was awesome. Trying to remember the name of it. I always think of, it's similar to Jeff Bezos' company. It's not Blue Origin. It's something like that, but it's basically the ability now, if I have international employees, I can actually pay them in their home country, in their home currency directly, which is a really cool thing, because a lot of these, even smaller companies now, you're going to be having some international employees. Maybe you're 90% America, 10% international, and having that is going to really give the provider an edge. So I think he's been a great capital allocator. I mean, he's led the company since 2007, so I don't think it's like anything to really
Yeah, really
things.
from a small business, like small revenue base to over $1 billion. I mean, it shows impressive breadth of not very many people can scale up with the business.
Mm-hmm. Exactly. And I think he's one of the things I like about him, and this isn't like something that makes or breaks a CEO, but he's kind of maintained, in my opinion, just by hearing him speak and everything, a bit of humility, which I think is really nice to have in your CEO. Like he doesn't come off as super slimy or salesy. He comes off as kind of like the guy you go watch like a Chicago Bears game, with and grill outside. Seems like a good guy. And like I said, kind of got that vibe too when he took the time to like send us a personalized sales video, just saying, hey, we'd love to have you on. We think we'd be great partners, things like that.
Nice. So yeah, I mean, it sounds like they're management team checks out. Sounds like they're kind of the product checks out. It's got good unit economics. The one thing that a lot of people get concerned with software companies now is obviously the valuation. A lot of these companies trade at premium valuations. Paylocity is no different. What is, the valuation look like today? And maybe a question to lead into this. They 10x the revenue over the last decade to $1 billion. Right. Do you think that's possible again this decade, or give or take, 10, 12 years? Can they 10x it again?
10x, I doubt. Grow at a solid clip for many years, yes. So like management has maintained that they feel extremely confident they'll grow 20% plus for the foreseeable future. And based on their, recent growth, I think that's definitely possible. In my opinion, if you're looking at top line growth of 20%, 20% plus, as well as improving margins, I think it's a really actually attractive company at the current valuation. So this year, software companies have really run up a lot in valuation. So you have some companies going up to 60, 70, 80 times cash flow or earnings, depending on which one you like. They're only at, and I mean, it's still a premium, but about 34 times, I think, price to earnings, and about roughly the same on a free cash flow basis. So.
Oh, yeah. Disregard that. Ryan's internet's unstable for any listeners. That's why Andrew paused there. But continue on the valuation stuff. No, that's good. I mean, maybe you talked about the earnings ratio. It's in the 30s, right?
Right.
Low to mid 30s. Is this one where you say, okay, look, we're betting on the durability of the competitive advantage and the durability of the industry tailwind? We think, regardless of whether it's 20%, 15%, 25%, the revenue CAGR this decade is going to make up for this, seemingly high multiple.
I think if you're buying Paylocity now, you're making the argument that you think the economy will stay roughly okay in the next year to 2 years. So and this kind of maybe even leads into a question on what we think maybe the risks would be to Paylocity. They are going to have a double whammy if there's a recession that's serious. So we didn't talk about this, but all HCM companies do this, is every time they make a sale, not only do they get the revenue from the company, they get revenue from the float that they then they then get interest on. So right now, it's about roughly for every $1 of revenue, you get $3 of float. So let's say right now they have $1 billion in revenue, they'll have probably about $3 billion in client funds that they hold in between, when I pay them versus it gets deposited into my employees' accounts. So they're getting interest off that. Essentially, money market rates, I think last I checked was like 4.5, somewhere between 4 and 4.5%. So what you're going to have happen is if a recession hits, obviously there's going to be less jobs. So a company that gets paid based on the seats you have and jobs being available is going to get hurt. And then also they're going to lose on interest rate. I think as long as the interest rates don't get caught a ton, which would be the result really of a bad recession, I think Paylocity is extremely attractive here. I think that if a recession hits and rates get cut, then you're going to see quite a dip in the share price because the fundamentals are gonna get hurt too. So the nice thing is that the bear case is very much in your face. You know what it is. So,
interesting. Yeah. So they're going to hit double whammy if it's a recession. But that's something that, so that's kind of a near-term risk you could have heard in the short term, could maybe present a buying opportunity.
Exactly.
So maybe over any time period, you talked a little bit about maybe the 1 to 2 to 3 year time period for this sort of interest rate risk in the recession, but maybe over the long term, over the near term, why do you think someone, say you're buying Paylocity shares today, why does someone lose money on the investment? What are the biggest risks to the stock?
And you're saying more as a structural risk rather than like a near term. Gotcha. Yeah. I mean, with any of these B2B businesses, or it's not B, but businesses that deal directly with providing a service for a business, it's there's always a possibility for disruption. Now, I think in this space, it's not as much of a risk. I think that Paylocity is actually, more or less providing a little bit of that disruption by going in there and really being a fairly affordable way for people to have all their HR needs met. I guess if I were to say like what's going to long-term, why you would underperform is probably just for whatever reason, their products don't end up panning out. Maybe there's some bad investment by management, which none of these have been the case in the past, but that's what I would see happening. Maybe there's something like we talked briefly about Paycom's Betty. Well, maybe if another company sees that, replicates it, does it at a cheap price, something like that could potentially have them have muted growth in the future. That's not something that I personally see happening, but I think if you were to say what's the long-term thing that could really hurt them, it'd be that.
Right. Yeah. It seems like with a lot of these software companies, right now, this market seems to be acting fairly rationally. You saw, you said Paycom quotes a very high price, keeps maybe a nice little starting point for everyone else. Yeah. But I think the big concern is maybe some company comes in and you really never can predict this and goes for a DoorDash type thing and just blazes, try to, lose money on a bunch of stuff and make it up on the market share over the long term with a bunch of funding. That's kind of unpredictable, but I think it kind of leads to a different question when facing that threat, facing that maybe quote unquote moat test, as we like to talk about in Chit Chat Money. Maybe closing question here. Do you think Paylocity has high switching costs? And if not, why not?
You know what? I hear a lot of people say that HCMs are like they're very sticky, and they are, but I don't think it's because of high switching costs. I think it's because most of the time people are happy with the product. Like for me, switching was actually fairly easy. So I think it's more of, is their moat? I wouldn't actually say that there's like an amazing moat for any of these companies, because for me, a moat is something like Visa has a moat because Visa is the only one that can, well, them and MasterCard, they're like the only ones that play in their space. This one, the closest thing that you'd have to a moat is the fact that Paylocity has the highest customer satisfaction score out of any of the payroll management companies. But customer satisfaction can be fickle, something. So do I think there is a moat per se? Honestly, like my honest opinion is no. Nothing like amazing. I mean, maybe maybe the biggest moat is just like people being lazy and not wanting to switch their HR. But I guess, it's not like this company where you're going to look at it and go like, oh, that's a company that's structurally set up to monetize off of a structural advantage that they have over other people.
Right. It's not like a Microsoft Excel where everything's just super, super high switching costs. Yeah, it's an interesting one where there's a big market tailwind and the culture seems great. But I think the big concerns many investors have is, all right, the competitive advantage, the brand, is it really that strong? But I mean, you make a pretty good case here. Before we close, anything else, where can the listeners find you? Maybe give a little 30-second pitch for Capital Mindset.
Yeah, sure. So just thanks for that. If anyone wants to see me, I along with Fabio and Leo, run Capital Mindset. You can find us on YouTube. Just search Capital Mindset. It's got like a brain as the logo. We're also on Twitter. We don't have a really big presence there, but yeah, we do work there together. And if you guys want to find us, go look us up on YouTube.
Right. Yep. A lot of fundamental analysis there. And it's not the clickbait doomer stuff. Right?
No, it's not. No, we are not. We make fun of the clickbait doomer, all that stuff. Yeah.
That's right. Yeah, there's too much of that stuff out there. Okay, well, I'm going to hit the disclosure and then we're going to get out of here. Remember, we are not financial advisors. Ryan and I are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, for listening. Andrew, thank you for joining, and we'll see you all next time.